3, 2, 1. Ladies and gentlemen, thank you very much for joining us. Today we got credit chats dedicated to credit insurance. And today I'm very pleased to present my co-speaker, the very smart and famous Mr. Igor Zaks. Igor, welcome to Credit Chats.
Thank you, Andrew.
Igor, all co-speakers in Credit Chats receive one difficult question in the very beginning of the event. I define it in a quite simple way. And just before I ask, I always say I ask about professional side of your life. So don't try to go too philosophic. But first question, I present myself as creditologist, so the guy learning about credit. And in short version, who do you feel you are?
Difficult question, because you are what you need to be, in various type of situations. But where I see my sort of professional mission is connecting the world. I mean, in terms that I've been in banking, I've been in corporate, I've been in fintech, and I can speak the language, I can understand the issues, I can see the world through the eyes of people who are in a different parts of business. And where I see professional, I add a lot of value is providing the connection between it and applying this connection to resolving the problems.
So
that's on a very high level.
Yeah, on very high level, you try to connect people, you try to connect problem and solutions. So the Pope.
I'll tell you one short story. Maybe it will illustrate the point.
Please.
I started my career in banking, so I've been in Citibank, bunch of other banks, and then I moved to a Fortune 50 company. And about first week in the job, I get a banker coming to me, and he is saying, "Oh, we have a solution for you." I'm like looking him straight in the eyes, and I'm asking, "You forgot to ask me one question. You forgot to ask what was my problem." So that's the type of issue that I always think, because look at credit insurance, look at banking, look at corporate. Everybody have their expertise and their view of the world, and everybody trying to work with others because they need it. But what they very often miss, and I'm saying about all the different parts of ecosystem, is understanding how other people think and work. What I try to bring to the table, I'm trying to bring it when I can switch the language and I can move from one to another, and I can connect it. I can find a solution that works for multiple parties, and everybody thinks it's good for them. And then obviously everybody is happy and it's working much better.
Yeah, that's very clear. But thank you very much for mentioning the salesman who forgotten to ask about the customer's problem. I believe this is, I work with the salesman for quite long period of time, and surprisingly, especially now when I am kind of freelancer, I understand how important sales are, and I see so many salesmen who simply don't even ask. They don't even have an idea about asking whether or not I need something. They say, "We got this." I said, "Please go for at least one sales management training." This would be very nice for you, ladies and gentlemen. Okay, today's topic is credit insurance, whether or not it is friend or foe for the corporate or for the user. So let's start today. Well, Igor, you might have seen we started before we start Credit Chats today. We had a quick chat with Igor offline, and we just found that we started on our webpage, on our page on LinkedIn, a kind of poll, a kind of research, and with what we found three basic things. First of all, credit insurance is on top 3 of credit security or collateral or ways to transfer credit risk to a third party methods among others, the preference of credit pros and, finance professionals. What we also found is that the credit insurance main benefit is coverage for different risks, which we will also try to discuss today with Igor. And the main weakness of credit insurance is actually recall of credit limits. And Igor already kindly given his advice what to do not to make this credit limits recall a big issue for the company. But Igor, may I ask you, as a heating up cycle, whether or not your opinion about credit insurance, what I've just said, is in line with the general opinion or with opinion of our audience? So what is your view in general on credit insurance? What is the main what are the main limits and merits and limitations of credit insurance? If I ask you to answer this, Paul, what would be your answers?
No, I mean, the ability of credit insurance to take a risk of diverse credit risk is important, and it's relatively unusual among other type of players. Because, for example, with banks, with others who also take credit risk, it's typically limited to the customers, it's limited to the region. Very few people have ability to take a broad geographically and industry diverse credit risk. And the appetite existing in credit insurance and reinsurance that is backing it is a great advantage and can provide a massive benefit. And then how you deploy this benefit, there are many, many different strategies for different companies in different ways. In terms of the limitations, to start with, not every policy have cancelable limits. There are policies that have non-cancelable limits. You can get one if you like. But when we look at the limits cancellation, I'll look there a very simple way. What is the main disadvantage of a credit manager from a point of view of a company? He not always granting credit. So if there is a high degree of risk, the credit manager may decide not to grant the credit, and the same with insurance. So at the end of the day, you can get a non-cancelable limit. They're more expensive. If you are effectively saying that underwriter cannot adjust the risk, the pricing will be different. So the real question is, what is the cost benefit of this? Whether this is an issue or smaller issue, whether you are happy to pay significantly more or to get less risk transfer in exchange of non-cancelable limit. Because a lot of insurers, a lot of brokers will say, oh, we can offer you this great policies that have very high discretionary limits, so we don't even write them. You do it, and there will be non-cancelable limits. There will be, and very often this is the right decision. Very often it's the wrong decision. But if you have it, you just need to look what will be on the other side. The other side will be that you have higher degree of loss retention. So, for example, you will have a higher aggregate first loss. You may have a higher price, and you may also have a need to prove that you granted or did not withdraw the limit in case of claims. So if you have, say, a non-cancelable limit and you know the company is going bust and it can be proven, you might have a problem when you are getting the claim paid. So everything is on a balance. You just need to look what is suitable, what provides the best value for your situation.
Great, thank you very much. So I used to say that, working in finance or in finance sphere, we got exceptional benefit because one of the biggest exceptional benefit we have is actually we are able to calculate the balance. And the same story with the credit insurance. We just take circumstances we got with either particular customer or portfolio as whole, and we can merely calculate.
And I will go a little bit outside of the question of insurance, and yes. I will say about the basis of valuation. So in finance, if you learn valuation, there is an always concept of a best possible use. So if you have, for example, a piece of real estate, how do you determine the value? If you can use it to demolish the building and build apartments there, or you can put there a retail mall, or you can do something, the value of this real estate will be the best possible use, because somebody who can use it better than others will obviously pay more. And the same to me apply to credit insurance or to anything else. So if you get it, you need to look what is your best possible use. And within this best possible use, whether it makes sense. And by the way, I'm not saying in any way that credit insurance always should be used, or it's a universal tool, or it's a silver bullet. No way. But you need to look at situations when it provides value. And if it doesn't provide value, you also shouldn't abuse. Like, there are other risk mitigation tools, and you can also go without risk mitigation tools. And it all depends on your situation. So you really need to be rational and look there from point of view of what benefit it brings to you.
You just stolen from my tongue the question, and this is actually already an answer to the question I didn't even ask yet, which is, there are companies who believe this is the ultimate good for credit management, or from credit management of view. We will be speaking about that later on. But there are also companies who are simply giving up credit insurance because they found that the use of credit insurance in their business, in their situation with their portfolio, is simply unreasonable. Just as simple as, I spoke with those companies, and interesting thing, they say, we just calculated how much we paid as premium, and how much bad debts we would write off if we don't have that credit insurance at all. They found that the premium is simply higher.
So let me make it very simple, and let's go into my first point. You need to look from an eyes of the people on the other side. Credit insurance is a business. If credit insurers will pay more in claims that they collect in premiums, they will go bust, and this industry would not exist.
Mm-hmm.
So the credit insurer always need to look at what's named a loss ratio and what's named a combined ratio. So if you look at credit insurer and look from their point of view, they write premiums, they pay claims, they also get various costs associated with reinsurance, brokerage, administration, claims, all the different things. And what they need to do, they need to have a positive P&L. So you look at the credit insurers and say in a normal circumstances, you will look at a loss ratio of, say, roughly 50%. I'm saying overall, and it obviously depends, in different parts of economic cycle. And that means the combined ratio of something like, 75%, 80%. That they will get, and obviously they make some profitability. If they cannot do it like long-term anything alongside this line, it's not sustainable. There are crisis periods that people get, obviously, I'm saying insurer overall loss ratio over 100%, that happen, but again, that cannot be sustainable. That can only happen in a very short periods of time. So no way, if you are looking at insurance as a sustainable way to pay less premium that to get claims, it doesn't happen sustainable way over a long period of time. Okay. Can you have a particular year when you have a loss ratio of 300% or 500%? Yes, you can. And that happened, and they've seen it. But if you are looking, I want to have a policy and I want to keep it for 30 years, and every year I want to pay $1 million of premium and get $2 million of claim, insurer will be crazy not to terminate your policy.
Absolutely. So I completely agree with that. Look, you need to, sustainable approach. So what I just caught from what you said is that we should not judge on credit insurance based only, based on 3 months of cooperation. We need to take longer period, and
it's a relationship business.
Yeah. Once again, please.
It's a relationship business.
Absolutely. So you stay with credit insurance, and what I'm trying to say just as a conclusion, because I completely agree with it. So P&L approach has nothing wrong with itself, but we should not take like 3 months or 1 year of cooperation. We need to have a look in a longer period of time. This is one thing. And second thing, which I believe is important, and if you can comment on this, we also need to understand our portfolio. We need to understand the risk of our portfolio. We need to understand what do we bring to the insurer, what really a risk, what really sort of exposure we try to cover with credit insurance or whatever actually, because the question is quite wider. Credit insurance is one of the ways to secure credit risk. And but before we do, this is one of the philosophic questions, one of the important philosophic questions we have in credit management. Should we consider security option first, and then we need to know, and then analyze credit risk, or should we analyze credit risk and then try to secure it? To me, the answer is obvious, and to me, the only option exists, and this is the second one. But there are lots of companies who say we need to secure, and then if we cannot get security, you're supposed to go elsewhere. What would you think about this? What do you think about this?
I mean, look, from like if you look at any basic credit training you get in a bank or in any other place, you don't start with collateral. Never. You always need to look at underlying risk. And with credit insurance or with any other instrument, if you don't manage the underlying risk, it's not going to be sustainable, because you're not in the business of being paid by getting claims paid. You're in a business of being paid by your customers. You have this sort of like if you go to a plane, you don't expect to use a parachute. You have a parachute, and it's great you have a parachute. But if every time you go on a plane and you are coming back on a parachute, you will really not get a very good business. So the same thing here. So you always need to look at this as additional. And I'll go back to the first question about P&L, because if you are looking at a premium versus claims, it's not the full picture. So it is part of a picture, and it's an important part of a picture, because if you expect in average, say, half of your premium being, the amount of claims you are paid, then you are looking, your real expense is only half of the premium, because about half of this in average you get, claims paid on a regular basis on, say, gradual portfolio.
Let me correct you. We are not talking about claims, we are talking about bad debts write-off. To me, the real, the real basic is how much we would we write off. If we don't have insurance, we write off the bad debt. Yeah.
So let's go here. That's a very, very interesting.
I know you are detailed, and
you get a good question. So there are two ways you can look at it. One, you are looking from a cash point of view.
Yes.
Okay, because claim payment is cash, and complete write-off in terms of unrecoverable debt.
Yeah, that's what I'm talking about.
The other one is accounting, and the accounting point is provisions versus premium, and that's different.
Okay, let's may I just suggest, because if we try to use this concept of bad debts provision, we might be a bit misleading for the audience. I will explain why. Because bad debts provision is actually money we accrue from our profit. So we presume the spending in the future. So when we write off against the bad debts provision, we actually make this loss. We still take the loss, but we already provided for it. Just that's why it is called provision. But what I'm trying to say, when we got bad debts write-off, we anyway lose our own money. So for the purpose of comparison, or actually for the purpose of discussing the credit insurance. May I suggest we simply consider bad debts write-off as it is, without touching bad debt provision.
Andre,
We didn't make that accrual at all.
No, I'm just trying to be accurate from an accounting point of view. So on a cash flow basis, it's one thing.
Yes.
On a P&L, it's different, because on a P&L, depending on my credit policy, I'm just trying to be accurate in the way it's interpreted, as opposed to, whether economically it's right or wrong.
Absolutely.
Okay, there is an expense for me in terms of increase in bad debt provisions, and there is expense for me of premium being paid. And what I can do, I can have a positive P&L impact that will be because if my credit policy allow me to reduce provisions because of use of insurance, I provide less, I get positive P&L. That is not cash, that is not economics, that just depends on the credit policy. There is a second question that is on a cash basis in terms of money I actually lose. So, and by the way, that write-off, it also doesn't necessarily mean economic loss, because often you write off and then you bring it back, because sometimes you write off the debt and then you still recover it. And there is a
we're speaking about, let's take it, let's simplify it. Let's simplify it. We write off and never see money. Obviously, we may have. We may have from state. We might have still VAT or TVA or whatever, or GST in Canada it is called GST. We might have
HST, whatever.
Reimbursement. We also might have if we already paid from that sale, we already paid profit tax. We might still have reimbursement based on the legislation, but we say, okay, if we got a bad debt, we lose this money. We lose certain amount of money. So if we got customer who would never pay us at all, we've got nothing to recover for $1,000. We lose $1,000. This is it.
And let's go to my first point, because all I illustrated that you can take a different view, and even within accounting rules, you have different approaches depending on which statement you're looking. But let's stay with your definition and let's look at ultimate loss. So we are saying about a write-off that is unrecoverable write-off, you never see the money again, versus claims that is paid. And let's assume you get, say, a loss ratio of 50%, for sake of example. So that means on a net basis, you paid half of it.
So, what do you mean under loss ratio 50%?
What I mean, you paid $1 million of premium and you get $500K of claims being paid. So your claims paid are half of the premium.
Igor, sorry, may we stay with my 1,000? So we got a customer. Let's take one customer with whom we had an outstanding of 1,000, just for me to be clear, yeah?
Okay.
And we know that this customer will never pay us at all. We set aside bad debts provision. We set aside all the tax.
Sure.
Yeah. So we say we are losing $1,000 or euros or whatever. So if we don't have credit insurance or any other credit security tool, we merely lose $1,000. Yeah. Then we're speaking about other options. Say credit. In our case, we discuss credit insurance. So with credit insurance, in my simplified understanding, I should admit I am not as detailed as you are, but this is great. We have discussion today with you. So with credit insurance, if for instance we have it or we have had it before, we would sign a contract with insurance company whom we pay premium of certain amount. And if we have a credit event or whatever way we call it, default. And we have a reimbursement of about 90% or whatever it is written in the contract. So in that case, we merely lose only, first of all, we take on our side only 10 or 20% of that loss plus premium. There might be something else, like deductible, like something. But
Sure. Your example is actually quite bad because normal you have something named threshold, or you may have each and every. So basically,
yes,
most of the policies are structured in a way that very small claims are not being able to submit through various type of structures because it's in nobody's interest. Like amount of
yeah.
paperwork you need for a claim submission, you don't want to do it for $1,000. So
No. I'm sorry.
most of the
Okay,
policies will
let's
get,
take
a few $1,000,
$100,000.
Exactly. So let's take example of $100,000.
Okay.
So, and let's look at what's named a ground up policy that doesn't have what's named aggregate first loss, because there are policies that are saying we are not paying you first 100,000 or first million of losses, and we only pay you above it. But in exchange, you have a lot of discretion in terms of how you set up the limits. But let's look at the ground up that doesn't have any of this. So you're paid 90. So if you get 100,000 customer and you have a limit of 100,000 or more, and you get 90% reimbursement, you paid 90,000. So your actual loss is 10,000 on this customer.
Yes.
Okay. Now, but if you look at the impact of insurance, you don't look at an individual customer. You look at an overall policy. So on overall policy, you will have some claims, and like the loss ratio is an important concept. So you are looking what is your net impact. So you paid $1 million of premium, you get, in this example, $500,000 of claims cumulatively altogether being paid.
Yes.
So your actual cost is $500,000. Then the real question is, what did you get for this $500,000? Okay. And the argument number one will be you sleep better, because if it will so happen that the losses will go from 500,000 to 50 million,
yes,
you are still going to be paid, say 90% in this example up to what will be the maximum liability. That is typically something like 30 to 100% premium.
Yeah, sorry for interrupting you. So first thing we need to first thing we need to do about credit insurance, we need to have a look at the size, at the actual size of our portfolio. So what portfolio do we cover? If it is 100,000, or this is 100 million, or this is $100 billion. So
sure.
This is important thing to say. And then, if I follow your logic correctly, we need to understand what is the exposure of this credit portfolio.
Yeah.
So we need to understand. So we might have $2 billion portfolio, which consists of, for 100% of blue chip companies with AAA credit ratings located in United States and all the AAA, all the AAA countries. For that, we might still need kind of insurance, but the real exposure of this portfolio would be quite low.
And I will put another degree of granularity to it, that no insurer will cover all the risks that you have in your portfolio. They will go through the underwriting policy. So you will have companies that are low risk, the companies that are high risk. What is very likely, insurer will be very happy to cover all the companies that you have in a very low risk. So your AAA companies, for sure, insurer would love to cover. They will probably also cover a lot of companies that will be single B, but not all of them, some of them. So you will have a portfolio, and you will have some portion of this portfolio being covered. And what you need to do, and what I will always do, when you get into this agreement, is you need to look, and you do it by sampling, and you look what is likely to be the response rate, what portions of portfolio will be covered. And then, but again, insurers are not magicians, then the writing is not perfect. So even if insurer will look that saying, okay, this we are okay with the risk and this we are not okay with the risk, it doesn't mean the actual risk will be there. So we've seen, for example, insurers taking the risks on a company that go bust, and that's why the claims are happening. And we've seen the insurers not willing to cover the companies that are perfectly good risk and that never go into trouble. And by whatever, reason the insurer was doing, they are not comfortable with this risk. So their underwriting process is also not ideal. And what you always need to you look first, you need to see how the insurer is doing on this type of portfolio. And second thing that a lot of credit managers forget, you need to talk. Like if you are in a specific industry, if you know a lot about this industry, you know more than insurer. Like, if you are, say, in, I don't know, electronics industry, and that's a very specific industry. That's a fairly limited number of players, and you typically have a long-term relationship, and you understand a lot about their business. You probably know more than insurer in many places. And what it means, you need to talk to underwriter. You need to share what you know. You need to provide your argument. If you have a real, incompetent credit manager who cannot defend their point, first, the underwriter would not be particularly happy regardless, because they say you're incompetent, like we need to be extra conservative with it. And if you have a competent manager, first, the underwriter will be probably more willing to take a risk because say, you already look at this and we saw your performance. You very rarely lose money. You really know your industry. So we are generally more comfortable writing the risk if you are happy with it. And second, if we have a problem, and obviously it will not go to all the limits, but to the larger ones, we'll talk to you. We'll say, oh, why do you think it's a good risk? And that's a conversation, when I manage the policies, I always had with the risk underwriters, because they will say like, well, what do you have? Why do you think it's a good risk? And I will say, oh, look, like I have, the management accounts of this guy for last month. I know what projects they're doing. I have information about who are there and users. I have this, and let's discuss. And very often I will get a different decision somebody else will get, just because we have an open conversation, we share information, we talk.
Well, Igor, it was clear before we start the discussion that it's using the words of famous Stephen King. It's a business where the price is dependent on the buyer, and the more buyer the qualified is qualified, the better could be the price. We will come back to that question as agreed.
But it's not only the price. The price, by the way, absolutely. Because if somebody, and this is one thing I say to some people that I'm working with. If you have a complete mess in your credit process, don't go and think credit insurance is going to sort it.
Yes.
Sort it first and then go for credit insurance.
Absolutely.
Because if you get an absolutely unpredictable performance, like look at this again, and I'm not switching the sides. I'm saying a credit insurer. And I'm looking at somebody whose losses are all over the place. How much premium do I need to charge this guy? I have no idea. And I will make a very, very conservative assumption. Now, every time they will go to me and ask for a limit, I will go from an assumption they have no clue what they're doing. And maybe I don't know well enough about this, so I will be very conservative. So you will have a bad pricing, you will get a bad risk coverage. On the other hand, if you get a good order in your house, I will look, like these guys never get big losses. Like they really understand their business. They, very carefully analyze the risk. So I don't need to charge them a lot because I'm not going to lose a lot. And by the way, I can give them a lot of discretionary limit, because on the small limits, I don't really need to do any work. They can do it, and I'm comfortable backing how they do. And the big limit, if you have an issue, I will talk to them. So if you get a competent credit management, you will get a much better term. And this is, by the way, one of the interesting observation I see with people who are very, very negative about credit insurance. Very often there are people who don't run a tight shop. Sorry?
Let's keep it for the later stage. So let me abuse my host's capacity, because before we go to that, as we agreed, I got a couple of things to discuss. So we already aligned and we already see that. First of all, even in simple terms, if you come to credit insurance and insure and ask whether or not I need credit insurance, you already know the answer. And obviously, insurer would be happy to cover the whole portfolio. But I've heard speaking with a couple of, credit insurance industry representatives, and there is a contradiction between the customer and the insurer, because customer always keen to cover only their counterparts with high risk. And those with low risk, they see no necessity to cover, which to me makes perfect sense. Yeah, if I got a portfolio of 100 customers and I got, let's say, 10 or 20 customers with high risk, I would like to cover them. But at the same time, we understand that sometimes covering only these 20 bad customers might cost more than covering the whole portfolio.
Mm-hmm.
So this means that before we start using credit portfolio, we need to know our portfolio, we need to know our industry, we need to understand the situations we have, where do we go, whether or not we would need higher limits, lower limits in the future time. And we need to, as you said, we need to negotiate the terms and different scenarios of covering portfolio. Do I understand correctly? This is what you suggest to companies?
No, true. But let's look at this issue. That's very, very interesting issue.
Yes.
The biggest nightmare what insurers are always talking about is something named adverse selection. And that means that if you are allowed to select, you will pass the things that you know are problematic. So you know the customer going bust, and then you go for insurance. And that's what I see, particularly in North America, quite often. Company knows the customer is in a deep trouble, and then they start looking for insurance, and then they're saying, oh, but there is no appetite. Of course there is no appetite, because you very well know
for that,
the company is in trouble.
For that, it is absolutely clear, because if I know that customer is planning to file for Chapter 11 in States, or Chapter 7 or whatever procedures, it is very clear. I suppose to presume that my insurer supposed to know that as well, or otherwise I am cheating.
Okay, so let's go.
Let us, Igor, just for, let's say, for very simplified situation. Let's say we've got, I don't know, 10 or let's use 10 customers. Obviously, we're presuming that it could be tens of thousands. Yeah, we say we got 10 customers and we got 2 of high risk, which we know they got high risk, because we know they got very low credit rating, or they got very low. Well, we did, creditworthiness evaluation and found that their creditworthiness is very low. My understanding as a credit manager, my understanding as, whoever is working for the company, whatever my title is that I would need to cover only these 2 customers, whereas the key of credit insurer is to cover the whole portfolio.
And you can there is a product that you can do a selective insurance. You can go for individual customers. There is this question, and as I say, the insurer would assume. And again, if you look at any research about the credit, you have this concept of asymmetric information, that you may know something different from the other party. So there is always this type of risk from insurer point of view, that some non-public information that they don't know, and this is why you selected this particular customer. So of course they know credit rating and you know credit rating, and you both know it's a double B customer, except that you just chatted to them and they told you we are filing for bankruptcy in next month, and insurer didn't know it. And that, by the way, can also be a contingent situation in case of claim and things like it, on the discovery, whatever. But and this is the risk that is there. But let's go a little bit behind it and let's look there. And the approach I always take, first, we are not gods. We don't know objectively the credit risk. We make our assumptions. We may have good assumptions. We may be qualified to do it. We don't know for sure. So what I'm sure that people who were trading with Enron, that was an investment grade company, did not think it was a high risk. They thought it was a global customer of theirs who were in a very good shape, or many, many other companies that went bust. So you don't really know, to start with, where the risk is. So if you are thinking, in your portfolio of 100 companies, there are 3 companies that can go bust, you may be up to unpleasant surprise, because you may find somebody else is going as well. And then what you are looking, and the way I always do when I compare it, I'm saying, let's look at implied premium for the rest. So say, for example, I get 100 customers.
Yeah.
And if I get 10 customers covered, I'm paid a premium of $1 million.
Yes.
And if I get paid on all the whole list, I'm paying 1,100,000. I'm saying, okay, is it a good deal to cover 90 of my customers for 100,000? Okay, they're sort of low risk, but they're not zero. And if I look there and I'm paying a premium of, 1 basis point of, the exposure there, is it a good deal to cover for what I don't know? Because this 10 I know there.
Absolutely.
The other ones, I think they're not, but I may be wrong. And this is always a question, for what extra I am paying there, is it there? And normally, the insurance pricing on a whole portfolio versus the selective one is such that if you do any type of rational analysis, you are saying that's a good deal for the rest.
Absolutely.
Because, as a humans, we have biases. We have overconfidence. I've seen so many people who will say, I know for sure, none of these customers will ever go bust.
Oh, please. I mean, everybody, especially before the shipment. And if the person saying this is a salesman, I can guarantee that they will pay on time. I promise, I prove, I got everything. And
but many credit managers are doing the same. I mean, let's be fair. If it is, a well-established customer of yours, and
yes.
You've seen a few cases before when they find some solution, even when everybody's thinking it was a problem, you have a lot of confidence. And I'm not saying, by the way, your confidence is misplaced. You have a 90% chance they will find a solution. That means you have 10% chance. 10% chance they go bust, and they will not pay you. And your margin is not 10% on this deal; it's lower than 10%. So, but you will still think, no, we'll find a solution. I mean, we're optimists. We're optimists by nature. But again, if I can pay 1/10 of 1% for the 10% risk that is going bust, it's a good deal.
Well, absolutely. So, okay, before the most interesting question is coming to the stage, and we turn, because we don't have too much time today, we will turn to the questions from the audience. Ladies and gentlemen, I think I've forgotten to mention that. Please, if you got questions, type them in chat, and we will be answering them in Q&A part of our today's session. But Igor, I think we are still aligned. Obviously, we need to compare different scenarios and different options, and simply see how much we pay and for what we pay, and we still can choose. And To me, thank you very much for mentioning that. It's building of cooperation with the credit insurance is what is important. And we come with knowledge of our portfolio. We use the knowledge of credit insurance, and we build up a solution which will be, let's say, profitable for both parties. And then, currently, Igor already said that most interesting thing to discuss today, and I kept it for the later stage, again, for the purpose, whether or not, and actually it derives from my previous question, do we need to analyze customers and customers' creditworthiness and go for credit insurance, which for me and for Igor, if I remember our very, very discussion from a couple of years ago on LinkedIn. Obviously, credit insurer is the most interesting part to get, let's say, additional assessment of a counterpart in order to make their own decision. But whether or not credit insurance is actually an additional service to credit management, or credit insurance is actually outsourcing of credit management to a credit insurance. So can we outsource credit management to a credit insurer? To me, there is no way to do it. But what
So it's interesting question, and I will not paint it in black and white.
Okay.
And let me put it there. First, you never can outsource your core competence. Okay. You never can outsource your core competence. And to me,
absolutely,
granting the credit to your strategic customers is a core competence. You never can outsource it. And what I mean is, for example, if insurer declines the limit, it doesn't mean you stop dealing with this customer. If you are comfortable and you are confident that this is a good risk and insurer don't understand it, you continue trading and you work with insurer and you eventually get restarted. Okay. So if we are saying about, but I will put it this way, and that's why I will not go black and white. You have two types of businesses. You have a relationship business and you have a transactional business. Relationship business, when you deal with the customers over a period of time, you spend a lot of effort, you know about this customers, you deal there. There is also a part named transactional business. When you get a customer who give you an order, you see this customer once, you never see them again. This customer may be anywhere across the globe, and you have no clue about this customer. You have no private information. You will not be able to get any private information. And that's why people rely on some credit reports and some other things and run a very, very superficial process, because at the end of the day, the exposure is very small. The margin is okay, and you never ever see the customer again. And this is the case when actually you can look at this as outsourcing, because you outsource it any case. You don't really do internal process. You rely on some type of external report. So if you're looking at a pure transactional business, so you're looking at a small value transaction, you're looking at market you don't know, industry you don't know, customer whom you will not see again, you can look at this as some sort of outsourcing, because you are saying that I am effectively buying a credit report, but on top of me buying a credit report, somebody puts their money where their mouth is. So instead of getting the report from DNB, who have no responsibility for what they have, I get a limit from Covas, who probably done about the same quality work that DNB, but you know what? They're on a hook if they done it wrong. And this very transactional basis, you can look at this. But the more important thing, you never confuse transactional with relationship, and you never look at this as a way to run relationship business, because that's completely wrong.
So when we say small customers of low value, and in transactional business where customers come and go, and if you would like to increase your sales by credit granting, this could be kind of outsourcing. But when we say about key customers, long-standing relationships, growing volumes, and so on and so forth, you still need internal credit manager, because you need a qualified credit manager to even deal with insurance properly.
No, absolutely. And you have two core parts of it that we touch upon.
Yeah.
The part number one, you don't want to be completely dependent on insurer, because God forbid they cancel the limit. You can kill 30 years of relationship, millions of profit potential.
Absolutely.
Just because of some idiot who don't understand what they're doing. Like, you can never do it. Okay, that's one part. The second part is you want to be able to keep communication. And say you call an underwriter, and what exactly you're going to say to them? You are saying, oh, we get a great sales deal there, so give us the limit. And they say, yeah, but we look, it's highly risky, and that will be end of your conversation. It's completely different if you are saying, look, we know this and this about this customer. Here are their financials. Here's information about the project they're bidding on. Here is our trading history with these guys. Here is our analysis why we think it is, what the risk we think it is. Why wouldn't you consider, providing them limit? You have a different conversation. So if you are losing this competence inside of your company, you will get ultimately significantly worse outcomes from the conversation. And the third aspect is, if I get a limit, it doesn't mean I will use it. So if I believe, if the insurer is happy to give me a 10 billion limit, and I believe the customer is good for $1 million, I will trade to $1 million. Even having a 10 million limit, I will know that on a specific deal with this customer, if I'm very comfortable on this specific deal, I can go to a 10 million and I will be insured. And that's a very good thing to have. But absolutely. I will not routinely go to 10 million because I think that it may, and again, giving you a simple example. Say I have a customer who sometimes buy for inventory and sometimes buying for project. And if they buy for inventory, I'm not happy with them having more than $1 million of inventory because who knows what they will sell it. If I know they have a good project with an end user, then, I'm very comfortable going to 10 million. So I will have a limit. It doesn't mean that I will use the limit all the time. If I know they buy for inventory, I will go to $1 million. That is my own internal limit that I will put for this type of deal. And if I know they do it for a good project with a good end user, I will go for 10 million. That is my top insured limit. But if I will go for 10 million routinely, I will end up with a 10 million claim. I will end up with my policy, renewing at a much worse condition. And I will go a whole bunch of a problem because I don't do my job, not because insurer is not doing that.
So anyway, you need to have a qualified person to speak
exactly.
with the insurer.
Absolutely.
And coming back to what you say about the outsourcing, that's the question I always explain to. It's just different angle of what you said today. Is that obviously there could be transactional business, there could be project business, there could be relationship business, and different types of relations. I used to say when people ask me what is the real general rule, I always say that there is no similar couple of buyer and seller because all of them are different. All the situations and all the circumstances are different. But one thing I always ask people to remember about credit insurer or any other trade finance provider is that they are kin. Credit insurer, a bank who provides you trade finance or everybody, their kin is actually collectability of a debt. And when we are a production company, when we are a seller, our kin is to sell. And these two purposes might not be in contradiction, but vectors are absolutely different. They are pulling into different directions. So for that, you better have credit manager who is who remembers that the role of credit manager is to support sales.
And I will put one other angle that a lot of people are missing.
Yeah.
That the risk you're facing as a supplier may be very different from a pure financial risk of collectability of the debt. Your whole reputation in the country may be going down. You may have an end user who is going to sue you for the fact that you did not provide to somebody who's supposed to, for example, service the contract with him or something like it. You may have risk. You may actually even consciously decide you are happy to provide credit when you know you have 50% chance of default because you actually have a losses in case you don't do it higher than your exposure.
Absolutely.
There may be all the different contractual and other things. The insurer, they are looking at the exposure and their decision is, we have exposure $1 million, we have a premium of 10,000. Are we okay to write this exposure for this premium? This is a different value proposition they have, and they need to make a rational decision for what they do. Your rational decision may be different, and that's why I'm saying you may have a cautious decision to go uninsured when insurer is not providing it. You cannot make it complete dependency because you may destroy your business by doing so. And you don't blame insurer for this, because insurer is doing the right thing. Insurer is looking within what they're paid for, within their contract. They are looking what is the best service they can provide you. But that doesn't mean that the best solution for you, that the best service they can provide you. And also you can get alternative decisions. So most of insurers, for example, if you get a bank guarantee, they will not even ask you to pay a premium. You can take it out of insurance. So you may look and you say, okay, for this particular thing, we have a different decision.
So turning it positively, we say, that's what I wanted to say. So having professional credit manager in your company, you may use not only credit insurer, but trade finance, LCs and others, and actually having clear understanding how to go uninsured if you are, or go unsecured if it is necessary.
And one point here, we are talking now about credit insurance, but let's just for a second touch letters of credit. Yeah. If you don't have a disciplined process inside your company, you should never use letters of credit. Well, if you are not able to comply with the conditions, or you don't have understanding of what exactly is a condition, and what you need to know UCP 600 at the back of your mind at any point of time. You really need to understand, all the terms and all the things, and you need to understand how your logistics is working and whether you will get the right letters and right dates of every document. Because that's a formal process. They just go against a checklist. And discrepant LC is not what paper it's written on. So if you look to any financial, and I just pick an example, if you look at any financial tools that you are using, you need to use it competent. Credit insurance is just one tool, and you need to use it competent the same as any other tool.
Absolutely clear. That's what we suggest in credit engineering. I think in Tenzor you say the same. Use every tool with clear understanding of its properties. If you don't know properties of the tool, you might be, punching nails with a microscope because it is heavy. Igor, thank you very much. These were great comments, and we are moving to questions from our audience. Stephen is asking, considering money depreciates and time value of money, the insurance covers only the principal amount and not the interest aspect. How would a financial institution leverage on credit insurance on depreciation of money and interest component? So meaning that we grant a loan to a third party, but insurance only covers principal sum. What about interests, and what about the depreciation? What about the inflation and all the stuff like that? Manage credit better would be the suggestion from my side.
But the answer will be, okay, we are talking about corporates. If you're looking about financial institutions, I deal a lot with financial institutions. Mm-hmm. You don't provide 100% advance rate. You always cover what you are reasonably secured on top of everything else. Yeah. So if I am a financial institution, and as I say, I've been in financial institutions, I advise financial institutions, you will not provide 100 advance rate. You will provide an advance rate based on what is secured. So if my insurance is covering only a certain percentage, only some deductibles, it doesn't cover interest, whatever it is, I will advance against what I expect to be recovered. I will not advance more. If I advance more, I will look at this as unsecured credit against, for example, the person who is doing the borrowing. And I will not view as the enhancement as being 100%. I will look at enhancement covering part of it. And I will price the structure accordingly if I am taking this risk, or I will not take it if I only rely on insurance. That's the answer.
Yeah. Completely clear. So, to me, we should not expect, fish, climbing the tree. Insurance are in their business, and they're covering principal sums, and they're covering what is called worst case scenario, when we lose the principal sum, the interest, and everything. And having insurance, we might have only 90%, or let's say 80% or 60% cover it, and then the rest is on our side. And depends on how do we structure the deal with credit insurance. But again, we shouldn't expect fish to climb the tree. Not to judge on it. Another question, what do I do if I have a risky customer which I cannot get cover for? Because no insurer will grant a limit. And another question, like as a continuation, why is there no market for more risky buyers? Well, Igor, the floor is yours. If you're unhappy with the question, I will try to answer.
I'm happy with the question.
So because it to me it illustrates the situation in terms of attitude. So please, if you have your answer, and then I will add a couple of words maybe from my side.
There are different markets. You have you have market for debt of a companies who are already in bankruptcy. You have so-called receivable puts and bankruptcy puts, when you can actually cover the risk of companies that is already in bankruptcy, even up to there. It's obviously a different pricing, very different pricing from insurance.
Yes.
But people will bet on expected recovery. So they will say you have $1 million of debt and we expect the recovery to be 30%. So you will expect 300K. And we want to make money on this. So we'll buy it from you for 20 or 15K. And, will take us 2 years to go through litigation and through all the recovery, and we'll recover something. There is a market. There are people who are doing this type of business. You have distressed portfolio sales. You have a market. Just insurers are not in this business, most of them. And again, we can look why they're not in this business, because it's very difficult to predict the insurance market not working with this, whatever. But there are specialist debt buyers and specialist funds and specialist structures dealing with this type of risk. And there is a market for it, not very big, but there is a market.
Yeah, I completely agree with you. I mean, there could be a price, but we should remember that there could be the level of risk which is not acceptable to anybody just to take it at the cost we are ready to pay, or at the price we're ready to pay. And in that case, again, answering your question directly, I would say, okay, we put under risk, say, $1 million, and then we need to compare the, risking $1 million against profit or against other benefits we receive because of this transaction. And if and then we compare this 1 million risk, I imagine we lose it.
And again, let's also split. There are two parts of the question: whether you do it before you do sales, or whether you do it with the part of your portfolio that is already distressed. Now, if you do it before the sale, you also need to look whether it's worth it. If your margin is 20% and your cover will cost 50% because people expect, that it's almost certainly going down, you're losing money. Like, you shouldn't do it. Even if you're able to cover the risk at this price, it's a loss-making deal.
Yeah.
And if it is already part of your portfolio, you cannot insure known risk. You cannot insure the house that already burned. You insure the house that is not burned, and then, if unfortunate event happened, you are covered. So that's not an insurance market. There is a distressed sales market. There is also outsourced collection. There are all the different things you can do if you want to clean up, the real old and real distressed part of your portfolio. But insurance is not the solution for it.
Well, I completely agree with you, Igor. Insurance is not fit in every single situation. There might be other solutions like, maybe bank guarantee, or maybe using third-party kind of other security from the third party, partially advanced payments, or whatever it is. We just understand that, this customer is of higher risk. If we are comfortable of taking this risk because, let's say, benefits are higher than the risk, is one.
But I'll tell you, I get examples when we traded with companies that were in a formal bankruptcy, and we managed to get a bank guarantee for them because they are the creditors thought the recovery will be higher if a key supplier will continue supplying.
Absolutely.
And therefore, even they know they're not going to recover whole of their money, they thought they better extend another $1 million credit line to provide a bank guarantee to improve their recovery by 50 million, as opposed to not to have it and then, get company to go into liquidation as opposed. I'll give you an example. We were trading with a subsidiary of company that was in a very high profile bankruptcy case. But subsidiary was solvent. And we were a key supplier. So the administrator of the parent company make a decision. They will ensure the subsidiary will pay like a clock because they want to sell it as going concern. And we had this conversation. We were happy to extend unsecured credit to a subsidiary of bankruptcy company. We were paid like a clock. They were sold. Everything was fine. But you really need to judge and you really need to see the specific situation and what is the right solution. And as I say, in most of the case, insurance is not. But, doesn't mean there is no solution.
Yeah, absolutely. So every time we need to look at details. There is no, one size fitting everybody. And, the credit insurance or whatever, we need to find...
It's not a silver bullet.
One simple thing is that we just need to remember that, every single couple of seller and the buyer is different, and there is always a way. And actually, credit management, that's actually the conclusion I took from my whole career and speaking with many credit managers, is our job in terms of credit is to support profitable sales. Sometimes assuming credit risk of a customer, this could mean that we have to make this deal profitable, but we just need to find a solution. Sometimes just cash in advance would be the only solution. But again, we need to consider risks and benefits of a transaction and then take a decision. And decision making would never be easy. It's always a torture. I don't know. Some decisions are obvious, but very often decisions somewhere in the middle where the credit risk is not obvious. Well, this is it. I had in my corporate career, hundreds of examples where the company is taking, high risk customers and grant credit just because they see perspective, because this is cooperation and we need to build up this relationship. And sometimes amounts for one company, which could be considered as big, for another company could be like, pocket money. I mean, every case is specific and we need to consider it. Ladies and gentlemen, we still keep Igor. We already a little bit behind the schedule. If you have more questions, please do not hesitate to send them to us, to Igor in social media, or to me directly. You got our email. Please forward. We will be happy to answer them. Igor, maybe couple of words, couple of last minutes to wrap up today's discussion. What would you suggest to our audience in terms of using credit insurance and credit security and doing credit management?
I think the biggest sort of takeaway from me is that you need to be rational. Like there are no good things, there are no bad things here. There is things that is right for the right business, for the right situation. And you really need to do a bit of a homework. You need to understand your business, and that's the first thing you need to do. Because if you don't understand your business, it's very difficult for you to make somebody else to understand your business. And that's where you go with it. And the second thing is you need to understand what are you trying to achieve, because credit insurance can have many, many different purposes. You may need it to provide additional risk capacity to be able to do more sales. You may need it to put it as a part of financial solution with your finance provider. You may need it to outsource some portion of your business in a very transactional part of your business that you don't really want to do in-house. But again, you need to see that the part you are doing, you can actually afford to do without causing this sort of problem. You may have a lot of other needs and other users. So what you need to do, you need to understand first, what is the problem you have, and second, whether this is the right solution. There are many other solutions you can apply, so it's only one of many, and you need to find the right place. And the other one, this requires discipline. Any type of external process, as they mentioned with OCs, with others, requires some discipline. So unless you have a disciplined approach to your own credit management, just bringing another partner or power partner is not going to fix the broken process. You need to fix it, and then you need to pick the partner.
Thank you very much, Igor. I just echoing what you just said. One of the best advices I got about credit, I received in my life in credit risk, was from Joe Pimbley, who said that success in credit granting and in credit management is not correlating with either use of credit insurance or credit analysis or qualification of credit analyst and everything. It correlates with how much or the depth the creditor understands the business of the borrower. So I wish every one of you low losses, high sales, and as here in French-speaking environment people could say, bon credit. Thank you very much for joining us. Igor, special thanks goes to you and all of my gratitude for today's discussion. See you on the next credit chat.
Thank you, everybody.
Stay tuned and have a nice whatever time you have. Have a nice sales and low losses. Bon credit.
Thank you.